Well, good morning, everyone. Thanks for joining us on a very cold day here in Michigan. You might be able to hear I'm just getting over a cold, as are many of us who brave the great outdoors to shovel snow this time of year. So just bear with me if I'm a touch gravelly today. I can't imagine a better time to be talking about new GASB statements because no one will be distracted looking out the window wishing that they were outside instead of being in here reviewing new standards. If you don't know me very well, I'm the training lead for our governmental practice here at Raymond. I've spent my whole career working with GASB reporting entities, and my primary focus is on assurance for local government units. Um, as a training lead, I train on a number of topics for various professional organizations throughout the year, and I'm a repeating speaker on topics from basic accounting and financial reporting all the way through best practices on financial management. Though I spend most of my time speaking about two particular topics, new GASB statements and uniform guidance, because those topics are particularly relevant to any organization reporting under governmental GAAP, and also there are regular updates and or changes to that guidance, hence today's session. So just to dive in a little bit on what we're going to be talking about today. First, perhaps most importantly, I'm very glad to be sitting here talking about new standards that, for the most part, are not going to require substantial new journal entries, aren't going to require you to dig up as many old contracts related to subscriptions, leases. I know that the pain point for many governments in the last few years, or anyone reporting under GASB standards, be it higher education, et cetera, it's been difficult to implement some of these standards. So today we're going to be talking mostly about standards that relate to financial reporting. We're going to spend most of our time today talking about upcoming statement number 103 related to financial reporting model improvements. This is the first major overhaul to GASB 34 since 1999. We'll also spend a little bit of time talking about statement number 104, disclosure of certain capital assets, and the most recently issued GASB statement 105, subsequent events. At the very end of our discussion here, we'll talk about the upcoming GASB project timeline and what they're currently working on and what you should be looking for coming down the pipe. With that, we have our first polling question today. Which GASB statement do you think will have the most significant impact on your organization? I'll give everyone a moment to answer. All right, so our first GASB statement today, GASB 103, Financial Reporting Model Improvements. If you were here last year, we did talk about GASB 103 at last year's 2025 Governmental GAAP update. We're going to spend most of our time here today discussing this statement. First, it's going to be effective for periods ending on or after June 30th, 2026. So for CVTs, anyone with a June 30th year-end school districts, this statement will be applicable to your next upcoming financial audit. So why did the GASB issue a new statement on financial reporting? Well, the GASB regularly does post-implementation reviews on standards, and that includes standards that have been around for a while. And over the years, the GASB and their deliberative processes decided that it was important to improve the effectiveness of financial reporting by modernizing GASB 34 after about, well, it's been around for about 25 years now. They also wanted to address some of the stakeholder feedback and identify problem areas, both from users of financial statements and also from the GFOA and their review process of ACFRs, and wanted to improve clarity, relevance, and avoid some of the boilerplate disclosures that might perhaps together improve comparability across governments. So perhaps I think the most important result of GASB statement number 103 are the things that aren't included in this new statement. First, there are some things that were considered at the beginning of the deliberative process, like changing the current financial resources measurement focus or changing the modified accrual basis of accounting for governmental funds. Neither of those changes were made in the final standard, which is important because those would have been substantial changes to the reporting model that we're all used to working with. So I generally think that this is a very good thing and keeps us all on a level playing field. Second, there also was no change in the presentation of governmental fund financial statements in actual financial reporting. So we said no changes to the measurement basis, no change in basic presentation of governmental fund financial statements, and no changes to GASB concept statements surrounding governmental funds and or the measurement focus and basis of accounting. So again, for governmental fund financial statements, not a lot of changes here in GASB 103. What areas were affected with GASB 103? Well, we're going to talk pretty extensively about the changes to MD&A, Management's Discussion and Analysis. We'll talk briefly about the updated discussion of unusual or infrequent items, which replaces the old terminology and definitions of extraordinary and special items, hopefully with a little bit more clarity. And maybe the biggest change is going to be presentation of proprietary fund financial statements and classifying the different inflows and outflows that are presented on those statements. There are also potentially going to be some presentational changes for major component units. We're going to talk about presenting budgetary comparison information and how that might change a little bit from your existing practice, depending on how you've been showing budgetary comparisons in your financial statements. And then there's a brief discussion of updates to statistical information if you're presenting as part of an ACFR report. So first on the list, changes to management's discussion analysis. This statement limits the related topics for management's discussion analysis to 5 particular areas. And I think it's important that they use the term limits MD&A. One of the emphases and focuses that you're going to notice throughout today's presentation is that the GASB is trying to distill down a little bit MD&A and other financial reporting into things that are really relevant to users of the financial statements. They want to focus intensely on the why. We'll talk about that in a moment too. And they want to remove or eliminate as much duplicative or unnecessary financial reporting information as possible. So when I think about this standard, I think about it potentially distilling down, trying to make statements more comparable, and trying to remove unnecessary financial reporting by really giving clear guidance of what is really truly necessary for financial statement reporting. Now, if we're going to be thinking about how do we change our financial statements, how do we make the required updates, we need to have a framework in our minds of what have we been doing versus what are we going to be doing under GASB 103. So this table just kind of tries to break down, we said there are 5 sections of MD&A required, limited to under GASB 103. How many were there in the past? Well, roughly 8 if you sort of aggregated MD&A presentation from GASB 34 and other requirements of other standards. So first off, still going to be an overview of the financial statements. In the past, it was called discussion of basic statements. Now it's called overview of the entire financial statements, trying to give the user a picture of what is going to be presented to them throughout the rest of the financial report. Second, financial summary. In the past, we called this condensed financial information. I think we're still going to have a roughly similar framework. In MD&A, we're going to want to present a high-level summary of financial results. Third, GASB 103 is sort of condensing 2 portions, the analysis of the overall financial position and results of operations, and analysis of the balances and transactions of additional individual funds into a section that they're calling detailed analysis. And we'll talk in a minute about what this detailed analysis might include. We're trying to, again, condense down a little bit some of the other sections of MD&A previously reported. Fourth, we're going to have a section on significant capital asset and long-term financing activity that replaces the old section called description of capital asset and long-term debt activity. Long-term financing activities include things like leases and PPPs. And finally, currently known facts, decisions, or other conditions. That's going to replace the currently known facts, decisions, or conditions of future significance. The very last section, MD&A used to require analysis of budgetary variations. That's now going to be moved into RSI, and we'll talk about how that will be presented in a few slides here. So remember, I said we are limiting MD&A. We are distilling it down. And one of the particular areas of emphasis from the GASB, and if you are doing ACFR reporting, you have probably noticed, at least I have noticed, and probably a lot of those who are actually doing the ACFR reporting on the client side too have noticed, that GFOA has really picked apart the you need to explain why in MD&A. So I've seen a lot of GFOA comments on ACFRs of, you're telling me what happened, you're telling me the when, where, and how that revenue changed, that expenditure changed, but you're not telling me enough about why. So in GASB 103, there's actually this explicit requirement to explain why. And the GASB gives some examples of this, like if you're going to tell me that property tax revenue went up, it's not enough to simply say we collected more revenue. Excuse me. Not enough to say we simply collected more revenue. You have to say, did rates increase? Did the property tax base increase? What were the underlying economic factors that really drove this change in revenue or expense, et cetera, et cetera? So we see that actually called out specifically in GASB 103. All right, let's try to take this from the top down here, sort of mirroring that table we just showed about how management's discussion analysis might change. First, overview of the financial statement stays. GASB thinks it's really important to be able to help users understand what do the different financial statements mean and how do they relate to each other. So this is figure A1 straight out of the standard itself. The GASB is giving us an example of how we might present this sort of overview to users. And I've seen, again, continued emphasis by the GASB on diagrams, other visual ways to represent beyond just paragraphs of explanation so that folks can maybe see, distill, understand in their minds, hey, under the government-wide financial statements, we're going to break out into 3 areas: governmental activities, business type activities, component units. And then within those areas, here's how internal service funds get presented. They're proprietary funds, so they show up under business type activities, but they service primarily governmental funds, so they show up on governmental activities on the statement of net position. So trying to help users understand some of the things that might be opaque to them since they're not on the inside of ACFR preparation the way that many of us have been for years. There's also this requirement in 103 to add discussions of significant policy changes. And this is mentioned in a couple of places, but again, it kind of goes back to the why, right? The GASB really wants us to be explaining what happened, what changed, either an underlying economic factor or in a policy like a rate change or a fee increase on water and sewer charges or a hiring freeze. What policy changes happened during the year that could really help us understand the movement on the income statement or the inflows and outflows of any particular activity within the government? Remember, we gave a new name to the area that in the past described capital assets and long-term debt. Now it's going to be capital asset and long-term financing activity. And of course, the primary driver for this is needing to include leases, SPIDAs, subscription assets, and PPP assets, if you have those, in your MD&A and discuss the significant changes therein. I think for the most part, this stays pretty similar to how it was presented in the past, just needing to include that information on lease, SPIDA, PPP. And finally, we've changed the name of the last section in the MD&A to currently known facts, decisions, or conditions. Again, just like in the past, we're still going to talk about economic or demographic changes. We're still going to talk about the factors used to develop next year's budget, but for the first time, they really want you to dig into the expected changes in budgetary net position or budgeted fund balance. So there may be some more discussion and explanation required of, well, we're saying that we ended the year here and that we're projecting next year to go to maybe higher or lower place when it comes to net position or fund balance. Maybe we're budgeting for a use of fund balance. Help analyze and explain why next year's budget is saying we're going to go up, we're going to go down, trying to provide some connection between the budgetary balances that are being disclosed and the actual GAAP basis balances that are presented in the financial statements. All right, and that brings us to our newest definition in GASB 103, unusual or infrequent items. In the past, we might have called these extraordinary items or special items. Now we're going to call them unusual or infrequent items. And so we're not necessarily going to substantially change what might have been purported as extraordinary or special item in the past, but we are going to give a clear definition of what does it mean to be unusual in nature or infrequent in occurrence. So that's an event or transaction that is abnormal and significantly different from the ordinary or typical activities of the government, or infrequent occurrence, an event or transaction is of a type not reasonably expected to recur in the foreseeable future. Now, I think Michigan is about number 50 on the 50 states, maybe we're 49 in terms of natural disaster events. Now, some of us might think that some of these snowstorms are natural disaster events, but when it comes to the National Weather Service, they classify things differently. So I think we'll probably have slightly less of these here in Michigan than maybe some other states might. But we'll get to some actual examples of this here in a moment. So how are we going to present these unusual or infrequent items? We're going to put them as the last flow item before net position or change in net position or fund balance. And we're not going to net them. Specifically, we are not going to net them against each other. If we have revenue or expense, an inflow and an outflow, we're not going to say, well, the net result was X. We're going to show them grossed up. You can see a lot of the changes that have been required over the last few years, including GASB 100, more disclosure on the face of the statement for prior period adjustments and wanting to show them in gross amounts. Same here. We're going to show those grossed up and not netted. So on the inflow and outflow side, we might, for example, say there's a disaster recovery grant due to some type of natural disaster that occurred, qualified as an unusual or infrequent item. And of course, there was an impairment loss on some of our existing assets from damage caused by that natural disaster. In that case, again, we said we're going to gross them up. So we show the disaster grant revenue on one side, we show the expense loss separately, and we'd show the net total. I'll show you exactly what that might look like just here in a second. And I think that brings us to polling question number 2 about your plan to address the new requirements of unusual or infrequent items under GASB 103. Hopefully everyone's answering that they have a plan or at least are working on a plan. But of course, the answer is no, we need guidance. Reach out and we'll talk about it after this session. So back when I was talking about sort of the summary of GASB Statement 103 and the potential changes in presentation, I mentioned that maybe the largest change for a lot of governments is going to be in proprietary funds presentation. So that's enterprise funds, that's internal service funds, anyone presenting on a proprietary fund basis. So we're going to have, for our presentation of these types of funds, a new definition of operating and non-operating revenue and expense. We're going to have a new definition of a term that we're going to call subsidies. And we are going to have a new format for the statement of revenues, expenses, and changes in fund net position. So the way that the GASB has sort of chosen to structure this is they're going to give us specific definitions of non-operating revenues and expenses. And it gives us 5 primary things that they believe fall under the definition of non-operating revenues and expenses. That's subsidies received and provided. We'll define that in more detail in a moment. That's contributions to permanent and term endowments. If you're an institution of higher education, maybe you've got a large endowment. I know some school districts have endowed funds, though those are usually kind of on the smaller side. Revenues and expenses related to financing activities. That might be issuance of debt, some interest expense related to lease activity. There are a couple of implementation guide questions about that in the 2025 implementation guide. And also investment income and expenses. Finally, resources from disposal of capital assets and inventory would also be on the list of non-operating revenues and expenses. That'd be potentially your gain and loss on a capital asset at the time of disposal, or potentially could also apply to inventory. If your government maintains a sizable component of inventory and you have obsolete inventory that needs to be written off, et cetera, that would fall under the definition of a non-operating revenue or expense. There are some specific exemptions made when the activities constitute the proprietary fund's principal ongoing operations. So if the whole point of the proprietary fund is to, let's say, lease equipment to outside parties or other funds, potentially certain things that you might think of as financing activities that would be non-operating revenues or expenses might end up falling under operating activities because they constitute the principal operations of that fund. So it's an important exception to note. If you've got a particular situation, I'd be more than happy to talk through that with you. So since they took the approach that they're going to define non-operating revenues and expenses carefully, that means that we're going to get a slightly looser definition of operating revenue and expenses, and that's all revenue and expenses not specifically identified as non-operating. So in a way, this is sort of helpful. We can say, all right, if it meets the exact definition of non-operating, we know where to put it. Everything else is probably going to end up falling under operating revenue or expense. And so that's how we can format our decision tree for how we're going to present these proprietary fund statements in the updated classifications. All right, remember I said we have a new term to review today, and that is the definition of subsidies. So what is a subsidy? It's a resource received from another party or another fund for which the proprietary fund does not provide goods or services to the other party or fund, and that directly or indirectly keeps the proprietary fund's current or future fees and charges lower than they would otherwise be. So let's try to think about this conceptually for a second. If you are, for instance, running a transit fund and you have, of course, charges from users, and that provides the primary revenue source for the expenses that you pay out, the cost of running the buses, the cost of paying your drivers and their related benefits. Those fees that are being paid to users, those charges of services, that are being received from users, those charges for services are probably operating revenue of the fund. But if you have other things that are, let's call it subsidies or perhaps propping up the expenditures of that fund that are subsidizing the operations of that fund, like a grant, like a transfer from another fund, like potentially a property tax, that is keeping those fees lower than they would otherwise need to be to keep that fund running. So that's why we're choosing to call them subsidies under our new GASB statement definition. Subsidies could also be, remember on our, just thinking about this slide here that we just covered, these are perhaps inflows that are defined as subsidies. We could also have outflows that are subsidies, resources provided to another party or fund for which the recipient does not provide goods or services to the proprietary fund and that are recoverable through the proprietary fund's current or future pricing policies. This also includes all other transfers in, transfers out. We'll talk about that in a moment. But the important thing to be thinking about here is if you're an enterprise fund for a larger reporting entity and you're bringing in basically a net revenue, a net positive inflow year over year, and then you're taking and transferring some of that revenue to another fund, potentially you are creating a subsidy to that fund through your user charges and fees, which are higher than is potentially specifically needed just to operate that fund, right? That are recoverable through the proprietary fund's current or future pricing policies. So important to be thinking about potentially subsidies in that definition as well. The specific examples that the GASB provides in the statement itself of what subsidies are, says all transfers in or transfers out are definitely subsidies. Insurance reimbursements are definitely subsidies. And intergovernmental revenue, remember I said grants, I think are going to be a big component of what might end up being subsidies for proprietary fund presentation. All of those are specifically identified in the statement as examples of what might end up as subsidies on a statement of net position. I'm sorry, a statement of revenues, expenses, and changes in net position. So here's an example. You see here we have sample city proprietary funds, public utility, transit authority, some golf courses, some internal service funds. You see we have up in operating revenues. Most of these are funded primarily by charges for services, operating expenses for personnel, contractual services, potentially insurance claims and expenses. And then down in our non-operating section, we have non-capital subsidies. Intergovernmental revenue, probably grant or revenue collected from the state, et cetera. That's going to show up under the non-capital subsidies. Transfers in, transfers out. So this just gives us maybe a brief idea of how this statement itself might actually be labeled. To try to take it one step further, right? So factoring in some of the things that we've already talked about here, related to operating other non-operating revenue and expenses like investment income, interest expense. And remember, we said we're going to have that statement of unusual or infrequent items as the last item before the total increase, decrease in net position. This is a great example of what that might look like. So after our operating section, we have our non-capital subsidies. We have our other non-operating revenues and expenses. And then we have our grossed up, not netted down, but grossed up inflows and outflows for unusual and infrequent items. In this case, it's an earthquake that happened, and there were grant revenues related to it. And then, of course, the cost of the actual emergency response and cleanup. So the idea here is to give you a picture of what it might look like if you had non-capital subsidies, identified other non-operating revenues, and potentially some unusual or infrequent items related to a natural disaster or some other qualifying event. I also mentioned at the beginning of this section on Statement 103 that there could potentially be some major component unit presentation changes. So under GASB 103, we basically trimmed down the allowable options from GASB 34. For presenting component units. So your options are you can present as a separate column on the statement of net positions of activity each major component unit as long as it does not reduce readability. So you could present each major component unit right on the face of the statement of net position if it doesn't make it too vast or too unreadable. So that's option one. Option two, as a separate combining statement of major discretely presented component units included in the basic financial statements following the fund financial statements. Option two is the choice that we use almost exclusively at Raymond when we are assisting with ACFR or financial statement presentation. So that option is absolutely still on the table. You can have one component unit column in your actual statement of net position and statement of revenue, expenses, and changes in net position. And then you can have a combining statement as part of the basic financial statements following the fund financial statements. The option that is no longer allowed under GASB 103 that was an option under GASB Statement 34 was to provide a condensed version of the statements in the note disclosures as allowed under paragraph 128. That is no longer an option. So I think if you are working with us as financial statement preparers, this is probably not going to affect you substantially. Most governments that I've seen, worked with, et cetera, present under option 2, but if for some reason you were taking option 3 and presenting condensed statements and note disclosures, you could no longer do that under GASB 103. One of our last topics related to Statement 103 is presentation of budgetary comparison schedules. So in the past, it's been allowable to present the mandatory budgetary comparison schedules in basically one of two ways. You could present them in the basic financial statements, or you could present them in RSI. And generally speaking, the required funds to be presented were the general fund and all major special revenue funds that had a legally adopted or time-based annual or biannual budget. Most often, this applies to most governments that have a general fund and any major special revenue funds that they're going to be presenting either face statements of the RSI. Under Statement 103, you're going to have to present those statements in the RSI. That is going to be a change for some organizations that work with us as financial statement preparers. In general, in the past, we've presented budgetary comparison schedules as part of the face statements. Some clients have chosen to present them. Some firms have generally chosen to present them in RSI. They're all going to move to RSI now. So your budgetary comparison schedules for these required funds are now all going to be in RSI. What's not going to change is if you are presenting supplementary budgetary comparison information in the other supplementary information section of the financial report or the ACFR. So if you're doing an ACFR, you have a lot of other legally adopted budgets, you present all those budgets in supplementary information, it will all stay in that section, not be moved to RSI. There is one new, let's call it substantial change in how budgetary comparison schedules are going to be shown in RSI. And that is that there's going to be this new column called variance with original budget, over under final budget. We'll workshop that name a little bit, but generally speaking, the difference between the original and the final budgeted amounts is actually going to have to be shown as its own separate column, right? Everything else that you see here is the same old, the same way we've been doing budgetary comparison schedules for years, but that requirement to separately show the actual difference between the original budgeted and final budgeted amounts is new and is going to be a change for all financial statement preparers on schedules shown in RSI. Now, on top of that, remember we said back when we looked at the table of changes to MD&A that discussion of changes to budgetary comparison schedules was going to get moved to RSI. This means now that you'll also be required to explain significant changes in those budgetary comparison schedules in the notes to the budgetary comparison schedules or notes to RSI. Now, you say, Dan, what is a significant change? Well, the GASB doesn't give us an exact definition of significant change. I think we will have to, as financial statement preparers, develop some rules of thumb, think carefully about what is significant to the individual funds, what is significant to the financial statements as a whole, and we have to make some judgment decisions as preparers and reviewers of financial statements about what do users of financial statements really need to know about the changes in our budgetary comparison schedule. So you can see here the GASB sort of preferred format for identifying those changes and explaining the differences in those actual sections. You see here tabular format. Of course, tabular format was what the GASB proposed for a lot of the changes under GASB 100. They like tabular format here too. So you can see they're showing specifically in the columnar format the over-under of the general fund and the public safety and transportation fund, which I'm assuming is their major special revenue fund for this example. And then section by section there, the preparer in this example is listing off the differences between final budget to actual, differences between original budget and final budget, and then potentially in a section on unusual or infrequent items, if you have one, again, differences from original to final budget. So they've identified what they believe to be significant changes, both in final budget to actual and in original to final budget, are showing the dollar amounts of those in a columnar format, and then trying to give a good underlying why, right? Remember earlier on in this statement, we discussed the importance of explaining the why. That's also being shown here in the budgetary comparison schedules. Now, Could you do this in a different format? And the answer is yes. They specifically note in the statement and the appendices that you could have a paragraph format as long as you are still explaining all significant changes, both from original to final budget and from final amended budget to actual. So there's probably freedom in the specifics of how you do this, as long as you still meet the underlying requirements and provide careful, thoughtful explanation that really digs down into the layer of underlying circumstances, policies, and economic factors. If you are a government that presents or that is engaged only in business type activities or only business type and fiduciary activities, in the statistical section, and you are also doing an ACFR, right? So if you're presenting statistical information, you are going to be required to show revenues by major source for business activities and distinguish between operating, non-capital subsidy, and other non-operating revenues and expenses. Basically saying that the statistical information will need to match the way that the operating schedules are presented. Important to think about if you are, let's say, a utility authority that does an ACFR, you might have some difficulty, some requirements that need to be considered in terms of presenting that historical information in your stats section and reconfiguring that stats section to match your financial information in the actual face statements. The GASB also mentions something that's perhaps important for component units. If you have a component unit that's being issued before your fiscal year end, and it is going to be combined in the group audit for a date that is effective. So let's say you have a September 30th that's getting combined into a county's December 31st audit. That component unit is supposed to be adopting the principles of the GASB 103 so that their information can be effectively combined into the primary government's reporting unit that also has to report under GASB 103 for the first time. So important to communicate if you have substantial components as a part of your ACFR or your group audit. So high-level takeaways here. First, this is going to change the structure of financial statements in a fashion that's going to take some time and effort. If your auditor, your firm, maybe it's us, maybe it's somebody else, helps with financial statement preparation, make sure that both parties have sat down, looked over last year's statements, agreed in principle on how to implement, especially when it comes to ACFR presentation. That's going to be the biggest, most difficult change when thinking about implementing the standard. Consider the added time for financial statement preparation as part of the planning process, right? We can talk about the technical details, but if you don't give yourself enough time to actually implement, that could cause you issues with getting your audit out on time and meeting all requirements. If there is time, whenever you can make time, try to mock up those changes early for review, feedback, especially when it comes to MD&A and RSI. And if you have a proprietary fund or funds statements, make sure to take plenty of time to review those presentational changes, because some of them might require you to recode things, how they're being presented in your ACFR, or maybe even adjust your chart of accounts somewhat so that you can present that level of detail and make those coding changes. And I believe that brings us to our third polling question here. Which aspect of GASB 103 do you expect to find most challenging to implement? All right, moving right along here into GASB 104, disclosure of certain capital assets. Now, this is going to be a pretty short section. GASB 104 is effective for periods ending June 30, 2026 or after. But by and large, I expect the effect of this statement to be somewhat lighter than GASB 103, even on the applicable reporting governments. Why is that? Well, because the potential disclosure changes are somewhat narrow for most organizations. So under GASB 104, you might have a change in financial statement presentation if you display capital assets by major classification on the face of your statements. Not particularly common in my experience. If you display capital assets by major classification on the face statement and report capital assets held for sale as a separate major classification of capital assets, again, not particularly common. Or if you were supposed to be reporting certain assets as held for sale that weren't previously being reported as held for sale, maybe you have a change there. There's also some discussion of if you have something like land held for sale, a property inventory, etc., that might be categorized as something like one of those definitions on your governmental funds balance sheet, that could cause a fairly major change in reporting. Now, in practice, I see this perhaps most affecting land banks in the state of Michigan. If they were reporting property inventory or held for sale on the face of their statement. However, in the recent guidance from GFOA, there's still active ongoing discussions about how they're going to define and classify potential inventory balances as held for sale as opposed to things that truly classify as capital assets. So that guidance is still being developed, worked out in practice. So if you have a held for sale classification that is significant on your balance sheet, important to be thinking about that in the upcoming days and weeks, months, and be talking with your auditor about. Now, under Statement 104, capital assets are considered to be held for sale if the government has decided to pursue the sale of an asset and they believe it is probable, again, one of our favorite statements as prepares likely to occur, that the sale will be finalized within 1 year of the financial statement date. Now, I say, why is that our favorite statement? It is difficult to have a black and white on what is probable or likely to occur. The GASB does give us some definitions related to how we could, or at least factors to consider on how we could assess the probability that that sale would be finalized within 1 year. First, we could evaluate the extent to which an asset is available for sale in its present condition, the extent to which the government is actively seeking a buyer, such as putting the asset out for bid, the current and anticipated market conditions for selling that type of asset, and whether or not approval might be needed from regulators and the likely time frame for that approval. So again, it's not an exhaustive list. It's a judgment call. If you have capital assets that you are thinking about selling, that you are actively planning on using not just as investments, but as properties for which you are holding to obtain proceeds from those properties, that is definitely something that could be affected by Statement 104. But the other requirements of the statement, like simply having separate categorizations for PPP intangible assets, subscription assets, lease assets, all of those things are probably already being done because they were required under 87, 96, and 94. So for a lot of governments, I think this will have not a massive substantial impact on financial statement presentation. All right, and our last, most recently issued GASB is 105 on subsequent events. Now, there hadn't been an update to subsequent event disclosures since, I think it was like NCGA Statement 6 or 7. So the GASB felt like it was time to sort of distill down the rules, create new requirements for subsequent event disclosures, help us understand the types of recognized and non-recognized events that might end up being disclosed, and give us a very clear example of the rules for note disclosures. So this is not creating a new category of anything, but it is helping us understand and present comparably subsequent event disclosures for financial statement reporting. One of the things that will change under GASB 105 is governments will need to disclose the specific date through which subsequent events were evaluated. So even if there was nothing to disclose, you'll still need to have a sentence in your note disclosures saying we evaluated subsequent events through X date. What does that mean? It means the required date where the following two conditions are met. One, financial statements are complete in the form and format in accordance with GAAP, and two, all approvals necessary for issuance have been attained. So I think the thing that the GASB is trying to get at here is if for some reason you had completed your financial statements, you had gotten them through all the necessary approvals, both on your internal end. It had gone through finance committee if that was required by your internal processes, or been approved by the board if that was required by your internal processes. And for your auditor, here at Raymond, of course, we have a standards review process. We have to get through that approval and review before we can issue statements. If for some reason all of those things had happened and then the financial statements were not formally issued till a much later date, a couple of weeks, what have you, the auditor couldn't get to it, you didn't want to publish them yet, and it wasn't required because it wasn't a deadline, that the date that those conditions were met would be the date you would be responsible for disclosing evaluation of subsequent events, not necessarily the date that the statements were actually issued. All right, remember I said we're going to get two definitions as part of GASB 105. We're going to get recognized events and recognized events. Recognized events are subsequent events that provide evidence about conditions that existed at the financial statement date. If those conditions really did exist, the GASB says, that's what requires adjustment in the financial statements. So an example might be you had a major customer that had a bankruptcy shortly after year end, indicated deteriorating financial conditions that already existed. Should you disclose or should you adjust your books? The GASB says you should adjust your books. You should adjust your allowance for doubtful accounts, maybe write off certain receivables, make sure that your actual financial statements reflect those conditions that really did exist at the reporting date. So recognized means adjust the numbers if that condition was something that already was in place at year end. Now, non-recognized subsequent events that arise after the financial statement date and do not relate to conditions that existed at year end. These events do not require adjustments to financial statements, but must be disclosed if they are significant to users. These are things we probably think more traditionally of as subsequent events. This might be a debt issuance, a government combination, or a change to an entity's reporting structure. Bottom line here is, if it's non-recognized, it doesn't affect balances, we're going to disclose it, and the event reflects new conditions arising after year end, not necessarily things that really did exist and should have actually adjusted balances. So they're trying to draw a clear and bright line for us between these two categories of recognized and non-recognized events, and tell us when it's appropriate to actually adjust the financial statement amounts and when it's appropriate to just disclose those changes or those events in the notes only. If you do have a non-recognized event that you believe needs to be disclosed as a subsequent event, a description of the non-recognized event and its effect is required, as is an estimate of the amount of the effect of the non-recognized event, or the reason why an estimate of the amount cannot be made. So they give us some basic requirements for subsequent event disclosures of non-recognized events. I think in practice, this probably isn't going to change our approach substantially for a financial accounting and reporting. With our last couple of minutes here, we're going to talk about upcoming GASB project timelines. So these are things that haven't yet been issued, but that are coming down the pipe from the GASB in terms of their technical projected timeline. So the way that the GASB works through their technical projects is that they start with a pre-agenda research project. Then, if appropriate, they add that item to the agenda. They do an initial deliberation period where nothing is necessarily published except those deliberations. Then they have a comment period. Then they issue preliminary views, which is sort of like a pre-exposure draft, exposure draft. Then they have a comment period that they say should last about 120 days. They often invite comment for redeliberations. We'll see as we talk about these couple of upcoming technical projects that the redeliberation period can take much longer than 120 days, especially after a formal preliminary reviews document is put out. Then finally, an exposure draft is put out, an invitation to comment on the exposure draft, and then a final pronouncement is made once the exposure draft is approved and they believe they've had enough time to deliberate, accept comments, et cetera, on that exposure draft. The current projects under consideration are going concern uncertainties and severe financial stress, the 2026 implementation guidance update, the infrastructure assets project, and the revenue and expense recognition project. So we'll just go over these real briefly. Going concern uncertainties and severe financial stress. this project is basically supposed to clarify guidance for us as to when we should explain, disclose, how to express when a government is under either what they call SFS, severe financial stress, or has the potential to be dissolved. They call that probable dissolution, or PD. This is going to sort of replace the concept of going concern for governments. And I think this is kind of important for those of us that, especially that work in the audit space, because governments often do not meet the traditional definition of going concern, even if they're under, let's call it severe financial stress, because property tax revenues are going down. They might not really truly be going to be dissolved, which is usually a concern related to going concern for, let's say, corporate entities. So that focus on current conditions for severe financial stress and future events for probable dissolution are separated in this standard. And personally, I appreciate that. I think it's a good thing. I think it's going to provide more clarity. You could have a government that's revenues are going way down, but the state has told them that they're going to step in, maybe roll a school district in with another school district, and that would help us to assess appropriately what was going to happen to that government by both asking the questions, what is their current condition, and what do we really think is going to happen in the future? Because governments don't often just fold, file for bankruptcy like actual commercial entities do. The GASB is also working on updated implementation guidance in 2026. It's going to focus solely on implementing statement number 103. If you're a larger government and you do an ACFR, I strongly suggest that you have someone who subscribes to the GFOA GAFR Plus subscription so that you can be part of the quarterly webinars and events. They do a great walkthrough of each implementation guide as it comes out, all of the related questions, and the background as to why certain questions were considered and answered. I find that training usually very helpful. Third, there's a new project coming down the pipe on infrastructure assets. There were some decisions reached at the September 29th, 25 meeting. This pronouncement is most relevant to those reporting under the modified method of infrastructure asset reporting. I don't think it's going to apply to many governments. In fact, I don't currently have any clients that report infrastructure under the modified approach. But if you did, this project would potentially add some new disclosures related to maintenance and preservation of those assets, and an assessment of the conditions and information related to those estimates, and potentially some new RSI regarding maintenance. Now, the MGFOA Standards Subcommittee, which I sit on, provides comment letters back on all projects when they're in the preliminary reviews stage. And we did provide feedback on this particular standard, asking, things like, do we really need to adopt all of these items retrospectively as opposed to prospectively? Are some of these disclosures really relevant to financial statement reporting? Wouldn't they be better disclosed in a capital asset plan? So we try to be proactive thinking about the challenges that these could cause if it were fully implemented as an issued statement. And then last, perhaps most importantly, there's a revenue and expense recognition project that is coming. They think it's going to come in the first quarter of 2027. Remember, I said that the preliminary reviews process can sometimes last much longer than 120 days. The first preliminary reviews document came out on July 1 of 2020, and the final statement isn't expected until 2027. So I'm not going to say too much about this here today because we're still in preliminary reviews and a lot of things could change. However, this potential project could substantially change the existing framework for recognizing revenue and expense, and could have a fairly substantial impact on local governments that report under GASB standards. Would shift revenue recognition principles, would categorize revenue and expense differently from our current exchange and non-exchange categorizations that exist under GASB 33, and would provide potentially a change in the existing guidance on period of availability for governmental funds. So all of that would be helpful clarification. They propose basically a two-tiered category framework for recognizing revenue, category A, category B. It's going to require governments probably to formalize arrangements that previously lacked clear documentation. I think it'll affect maybe the most grant revenue recognition, where there potentially wasn't consensus on exactly how to recognize revenue, and or there weren't formalized agreements in place that made it clear when the performance obligations were met under those grants. So this project really could be a substantial change, and we at Raymond will be providing thought leadership and training on it as we get to the exposure draft and potentially closer to something being an issued statement and giving examples and guidance. So that brings us to our very last polling question here. Which area of the GASB project timeline are you most interested in learning more about? That brings us to the end of our presentation for today. If you hadn't had enough of me yet, there are more opportunities to get CPE, to learn about upcoming changes, both in our not-for-profit update that will happen tomorrow. We have 2 panel discussions on strategies for uncertain times and proactive cybersecurity in the public sector, which will be in April and October, respectively. And you can join me again in July to talk about updates to the compliance supplement and single audit requirements. At that point, hopefully, I'll no longer have a cold. So it's been wonderful being with everyone today. I'll turn it back over to Christina to close us out.
Thank you for joining us today. If you'd like to learn more, please visit raymond.com. And you can also email us at publicsector@raymond.com.